there are still options for individual stocks or individual investments that work in similar manners to ETFs. And by that, I mean they provide huge amount of instant diversification across geographies, across sectors. These kind of companies will be run by CEOs who act almost like investment
Yeah.
managers. So think of like great big conglomerates, serial acquirers, that kind of thing. Berkshire Hathaway is a perfect example
Yeah.
and would probably be top of this list in most cases. I think we talked about them like 3 weeks ago. So we're
Yeah.
going to give you a bunch of other options that work in the same way of these kind of blue chip foundational stocks to your portfolio. And you can just set and forget. And if you can honestly treat them in some shape or form like an ETF. Marie, how are we doing?
I am well. We're coming off the back of Cinco de Mayo, which is a holiday that Mexican people do not celebrate. But
No.
I
It also isn't Mexican Independence Day at all either.
no,
It's like
it's
the
not.
celebration of some obscure battle that
Yeah,
was it Corona decided that they wanted to
it's no. They defeated the French in a battle, but then subsequently lost the war. But I think it's nice to celebrate the small victories. I think that's good. That's a lesson we can all learn.
that's not this
Uh,
that's what this holiday should really be about.
yeah, celebrating the small victories. And so consequently, I celebrated by cooking an absolutely astronomical amount of birria beef, which is like very slow roasted, delicious
Yeah.
beef, which I haven't done in the past because you have to cook it at such a large quantity to make it worthwhile. And I'm like, I cannot eat that much beef on my own. So I used Cinco de Mayo as a ruse to invite people over so that I could cook a lot of beef. And it was delicious and very good. And I'm very happy I did it. But now my entire apartment smells like beef. It's been days. I cannot get it out of my apartment. All the windows have been open. I'm just really living in it. So, yeah.
Very good, very good. Okay, there's only one place where we can start the show, really. There's huge news coming out of Berkshire Hathaway's annual meeting last weekend, and that is that Warren Buffett is finally hanging up his boots.
Yeah.
So the 94-year-old is retiring at the end of 2025. Greg Abel, his longtime heir apparent, is taking over then from January 1st of next year. Buffett said he would still hang around and could conceivably be useful in a few cases, but he didn't really make it clear if he's going to stay on his
Mm-hmm.
chair. It's not Abel that would take over his role as head of the board, chair of the board. It would be his son, and I think this son and I think the rest of his family would control his voting rights um, after his death and stuff as
Yeah.
well. So the Buffett family will still play a very important role in Berkshire Hathaway and in its administration, but kind of the operations of the outfit is going to fall into Greg Abel sooner rather than
Mm.
later. The stock fell about 5% on Monday after the market got to react to the news. Do you think that's a fair reaction for Warren Buffett?
It was kind of maybe a nice send off if you don't think about it too much. Where they were
Yeah,
acknowledging, hey, like part of the reason that we invest in this company is because of this man, and if he's leaving, we would like it to be known that we will be sad that he's on the way out. But I also feel like Warren would be annoyed because he hates market overreaction and irrationality, and I think he would like to think that he has set up the company to survive without him and to continue his legacy. So a bit of a backhanded compliment, maybe.
yeah, 100%. And I think you touched on the important point there of setup to go on
Yeah.
without him. And that so much falls into this man, Greg Abel, who's been talked about a lot since about
Mhm.
2021. Warren Buffett has basically said he's going to be the next my successor. He came in, he ran Berkshire Hathaway Energy for years, and then he came over and essentially became vice chair of the company. He ran all the non-insurance
Mhm.
operations. And so this is where I guess the real speculation around Berkshire will come from is what is Abel going to do? Um, and it's really interesting. Actually, there's a fortune piece. We should include I think what we'll do is include the fortune piece in the newsletter that goes out after the podcast. It's worth reading if you're interested in Berkshire, if you're an investor in Berkshire, and just in general, like as in someone who's got one of the most important jobs on Wall Street
Yeah.
now. They did a big long piece on him. Seems very much um, very appropriate follow up to Buffett, if that makes sense. Like the opposite of a Wall Street type. He's from Edmonton, Canada, lives in Des Moines, Iowa, coaches his son's hockey team on the ice rink he paid for, the kind of folksy everyman. And then while also being an incredibly intelligent
Yeah.
businessman just beneath the surface, apparently he can speed read balance sheets and income
Mhm.
statements as if like, you would scan through 2 pages of a book and get out all the important information. So apparently massive genius, but very much an
Yeah.
everyman on the surface of things.
Yeah. My big takeaway from the fortune piece was that he comes from an accounting background, and that's why
Yeah.
he's very focused on the numbers. I liked that. That reminded me a lot of Warren. And the big takeaway from the fortune piece as well was he is much more focused on management, which Warren kind of famously wasn't. He used to buy these businesses and he was always so focused on quality. He would sit back and basically be like, well, I bought the business with the established management in place, and if they have got this business to a point that I like, I'll just let them do their thing. And that does not seem to be what Greg Abel likes. He likes to find businesses that maybe need a little bit of help or a little bit of a fix. It's a good buying opportunity. They were talking a lot about his work in energy in the early 2000s when there was basically a big energy bubble when privatization was allowed in some of the grid infrastructure, and that popped. And he went in and bought up a bunch of various energy providers for pennies on the dollar because he's really good at of identifying problems and fixing them and putting people in place to fix those issues. And some investors seem excited by that because, as we know, Berkshire Hathaway owns a lot of companies and they're in a lot of diverse fields. And so the idea was that Greg Abel might be really great at identifying weak points in assets that are already within the existing portfolio and finding people to be like, hey, can you go in and take a look at Aflac Insurance and figure out what tweaks we could be making to increase profitability here for the next 2 years or something like that. So that I think is an interesting development within Berkshire that maybe hasn't existed before.
Yeah, definitely. I have that written in my notes as well of Buffett was so hands off
Mhm.
and is probably missing a lot of synergy
Yeah.
opportunities. And in general, just optimizing the Berkshire portfolio because it is this absolute behemoth. I think it's the fifth largest company in terms of taking in revenue in the
Hmm.
US. And so much of that is decentralized. And if Abel looks to optimize its different divisions, take advantage of the conglomerate structure, where I know already like some of the companies lend to each other on favorable rates and stuff, but maybe you bulk order across your entire industrials line or something like that
Hmm.
and make it just a more cohesive unit.
Yeah.
Because there are clear improvements that could be made. Do you
Yeah.
know what I mean? Uh, and this is the difference. Warren Buffett was a CEO. He's a 94-year-old
Yeah.
man. He's not going to get into the weeds the same way that Greg Abel can. And like, I don't want to be don't want to be very cynical, but like he did seem his age
Hmm. Yeah.
in this annual shareholder meeting. It seemed very clear that this is probably, he was probably not on, I don't want to say borrowed time, but like the fact that we just took for granted that he was running this company at 91 and 92 and
Yeah.
93 seems almost crazy now when you see an almost frailer old man in that position. And I'm not saying that Warren Buffett won't be involved at all. I think there might be some opportunities to pop up with that cash pile and he'll
Oh,
have
yeah.
one last swing in this current market dip and the uncertainty that's around basically everything in the market right now.
Hmm.
Um, but yeah, what do you think, if any, are going to be kind of the big statement uh,
Yeah.
purchases under Greg Abel, or do you think it'll be quite boring? He'll at least stick to his energy stuff.
Yeah, he is very. There's something again that came up with that piece was the fact that he led one of the early pushes into wind turbines, and Berkshire is now the largest holder of wind energy in the United States, which I did not know. Um,
Which Trump hates, by the way,
oh, good.
just because they look ugly, apparently.
I mean, okay. I guess I'm sure, but they're really renewable, so there's that.
Yeah,
Um, So I do think we could get something interesting here because he picked up on wind really early, and that's an emerging technology. That's innovation. So maybe he would be somebody to have a finger on the pulse of developing tech. Maybe not in like AI, that's very cutting edge, but in something. particularly because he seems to have very deep contextual knowledge within energy, but he doesn't seem to have an issue doing deep research and going to experts and getting opinions on things. So I will be very interested to see what he buys, particularly like the cash pile is massive. It is so massive. What are we at? Like
Yeah.
380 billion or something? Like it's huge. And
Yeah.
so, gosh, he just has a lot to play with there. Also, it's worth saying he's not coming from the investing sides of things. He's coming from the non-insurance business management, which also means that he has had for, I think he take that over about 10 years ago. That's a long time to be exposed to lots of different types of businesses because Berkshire has a diverse holding within that umbrella. So he could be reading up on food stocks right now and be going, yeah, there's a lot of potential value here in, I don't know, Chipotle. And like we might see him come out and buy like 20% Chipotle or something crazy like that. So I'm very interested to see where he goes. I feel like he will follow in Warren's footsteps though, and he won't be buying anything urgently. The market conditions remain so bumpy and valuations are still pretty high. So yeah, that's what I'd be interested in. And actually piggybacking off what you just said, earlier about Warren, like he's been operating a company for so long at his advanced age. And it's worth remembering that a lot of Berkshire's outperformance these last few years has, number one, been delivered because of the bond market, because he holds so much cash due to the insurance. And that's not really if anything that Warren can control. But number two, a lot of the outperformance since about 2016 has been because of the Apple holding. And that has been
Mm.
sold off due to a rebalancing within the portfolio. And so there really is an
Well,
opportunity here to make a statement, I would say.
sold off to a point.
Yeah, yeah. Just
Yeah.
not entirely.
Still holds. Just make
Yeah,
sure
yeah,
he still holds plenty of Apple stock.
yeah,
But yes, he sold off a good portion of it. Yeah, yeah,
yeah.
yeah. The Apple conversation is interesting because I saw a lot of people compare, you know, the Warren Buffett versus the S&P without Apple,
Yeah.
but they took Apple out of Berkshire's holdings without taking Apple out of the S&P 500 holdings.
Oh, yeah.
It's
Okay.
just very, very unfair comparisons.
Yeah.
But yeah, no, it is interesting. I'd like to see. I don't think it's the worst time to take over.
No.
There's probably some fat pitches out there, and there's some not easy wins, but we're talking about along the lines of optimizing. Maybe he might divest some assets, stuff like that,
Mhm.
where he's more on the ground. He'll be able to kind of take a closer look
Mhm.
at the minutia of Berkshire, whereas Buffett has already always taken the helicopter view. So we might see it play out a lot differently there.
Yeah.
But yeah,
Yeah. It's also funny he doesn't really give interviews. We keep referencing this Fortune piece, but they actually didn't speak to him. They spoke to all these people who knew him in his
no, it's
past
everyone
career.
around him.
Yeah, and they got a quote out of Warren, which was funny. He emailed them, and it was like 2 sentences. He was like, "Yep, really like Greg. He's a great manager." And then Warren was like, "At 94, I'm not giving any more interviews. Thank you so much." And that was it. So
Please.
who knows?
Yeah, yeah. Okay, well, it's appropriate stocks we're going to talk about now.
Mhm.
So we promised stocks from last week. We had a big long episode about ETFs and passive investing in general. And for certain people, Irish investors in particular, hopefully these laws will change soon and we can take advantage of the simplicity of ETF investing then. But for now, there are still options for individual stocks or individual investments that work in similar manners to ETFs. And by that, I mean they provide huge amount of instant diversification across geographies, across sectors. And in general, they're run by some form like there'd be CEOs, but these kind of companies will be run by CEOs who act almost like investment
Yeah.
managers. So think of like great big conglomerates, serial acquirers, that kind of thing. Berkshire Hathaway is a perfect example
Yeah.
and would probably be top of this list in most cases. I think we talked about them like 3 weeks ago. So we're
Yeah.
going to give you a bunch of other options that work in the same way of these kind of blue chip foundational stocks to your portfolio. And you can just set and forget. And if you can honestly treat them in some shape or form like an ETF. Now, obviously, you have to be very wary of the intricacies of the business, what are their holdings and all the rest. But in general, they're going to act in some shape or form like an ETF. They're going to rebalance like an ETF. They're going to sell off underperforming assets. They're going to buy new assets and all the rest. So that's a way of thinking of these stocks or individual investments that get treated like individual stocks for tax purposes, but act like a much bigger ETF. So you're going to lead us off with the very appropriate stocks because we've just been talking about Buffett for
Yeah.
10 minutes.
So I want to talk about Markel. It is worth mentioning that I pitched Berkshire like 3 weeks ago within the context of if the market instability and the sell off of tech was making you really nervous and you thought, hey, maybe I need to rebalance and get some value stocks. I said that Berkshire is like such a solid pickup. So I will link that episode in the description below if you want to go back and listen to that. And it just discusses more of the cash pile and the potential ways that that capital is going to get allocated. So I would agree. Berkshire is definitely top of the list, but Markel is called the baby Berkshire. So it's pretty
Yes.
good. Its ticker is MKL. And it's a stock really that we've talked about maybe since 2016 or 17 in my Wall Street. Like it's always just been kind of an old reliable name that you can go back to. It has a really similar business model to Berkshire in that it used to be primarily insurance. And as people know, the insurance market makes a lot of money. They have a lot of cash. And so over time, as you become bigger and bigger and your cash pile becomes larger, you start to say, we should maybe deploy this cash into something. And so they start buying up businesses and they become serial acquirers. This company operates in three arms: insurance, investments, and ventures. The investment arms started first, and it's just a standard managed portfolio. Interestingly, its largest holding is Berkshire Hathaway. So there you go. You get some Berkshire exposure right off the bat. But it also holds things like Google and John Deere and Home Depot, all just like very large American publicly traded companies, not overly exposed to tech. It's more of a value play here, but it has a long legacy of beating the S&P 500. So it's basically like getting exposure to a wonderfully managed ETF or even a mutual fund without having to pay any of the fees. So that's a really solid bit of exposure. It, similar to Berkshire, has been benefiting from the bond market recently because similar to Berkshire, when you are in insurance, you're not allowed to hold insurance premiums in anything other than a low risk asset. So oftentimes that means that you carry a lot of 10-year treasury bonds, and those 10-year treasury bonds have been benefiting from exceptionally high interest rates the last few years. So they've been generating a lot of cash the last couple of years. So that's been great. But the interesting thing about Markel, in comparison to Berkshire, is while it does operate in insurance, it operates in a funky insurance market, which is that it goes after niche insurances. So rather than home or auto insurance that you would see within Berkshire's portfolio, it's more interested in stuff like classic car insurance, equine insurance, horse club insurance, jet skis, professional liability, workers' comp, stuff like that. And the reason that can be quite interesting, even in an environment of market instability, is there's not very much competition in those insurance markets because it's difficult to underwrite effectively in them because, as you can guess, there are way less horse clubs than there are cars. And so most insurance companies don't want to deal with it. So that means that you have way less competition and you can charge a premium, which means that Markel generates a lot of money. It's highly profitable. So that's a great way of getting access to the insurance market, which tends to be recession resistant, but also getting the added benefit of being in a little bit of in a monopoly space there, I guess you could say. But then we're going to talk about the third arm, which is again very similar to Berkshire, which is its ventures arm. This only started in 2005, and this is when the company started acquiring businesses. It became a serial acquirer. Interestingly, similar to it operating in like a funky insurance market, it also likes to operate within a funky ventures market. It's not looking at anything too fun or interesting. We're not looking at software companies here. It owns the Bremen luxury handbag company. It owns several IT consulting firms. It owns a company that builds dredges. That's thrilling. A paneling company, a food equipment company. It owns like a mass bakery, all kind of like funky stuff. But similar to Berkshire, it was just looking at businesses that are highly profitable, operating in a niche, well managed, and it just picks them up. And obviously, this is that classic Peter Lynch thing. Boring businesses often make a lot of money because people can't be bothered to compete with them because I don't think there's any kid like sitting in a Harvard dorm room right now going, guys, I'm going to start a dredging company. It's going to be incredible.
Well, actually, I'm going to disagree
All
with you
right.
there because that's where all these MBA, Harvard spit out come to. They go and they try to buy all these like profitable aging businesses and then modernize them.
That is the thing we
This
are
is like,
hearing on the Instagram videos.
yeah, this is their new route.
Yeah, they're not.
Harvard, you paint yourself in the corner there with the Harvard,
Alright.
because that's like a clear route for the Harvard
Well,
MBAs. But I get what you're
I was
saying.
thinking more of, like,
They
the
don't. They certainly don't
undergrads.
dream about it.
Yeah, yeah. I was
Yeah.
thinking of the
Yes. Yes.
Zuckerberg undergrads, writing on the code on the window, and we're all furiously
Yeah.
coding overnight. Gosh, the world would be such a different place if Mark had just thought about dredges instead of Facebook. But anyway, so it's just operating in these kind of funky areas. It's highly profitable. It's just a perfect little business to get a nice diversified holding. It's been doing very well the last 5 years. It repurchases shares routinely, which is actually something Berkshire hasn't been doing. I spoke about that 2 weeks ago. Its share count has reduced by 2.6% over the last year. That's pretty solid. It has allocated 3.7 billion to acquisition since 2005. That's pretty phenomenal. It generates 2 billion in net income from those acquisitions. So yeah, it's something to write home about, and I'll tell you that. One thing to note, though, is it does have an activist investor issue brewing at the minute. So over the last 10 years, operating income has grown at a 13.7% CAGR, but the stock price has only increased by 9.3% CAGR, which is a slight underperformance. And unsurprisingly, because of that, it has attracted some activist investor interest. And in December of 2024, JANA Partners announced that it was initiating a position in Markel, citing its undervaluation. And it has taken a 0.85% share, which, considering Markel is only about a $23 billion company, it's decent chunk. And management hasn't addressed the issue so far of what they're going to do. The big news that Jana went in there with was that they wanted to spin off Markel Ventures. So they wanted Ventures and the insurance and management arm to be separate from each other. Interestingly, from what I've seen, a lot of investors are not overly opposed to this idea, because sometimes, even though both segments are highly profitable and doing well and growing, it's almost like they're overshadowing each other simultaneously. And sometimes spinoffs can do very well in public markets. We've seen that in the past. So that's just something to keep an eye on, whether that happens. If it does, you can still effectively use the two branches as a way to get access to diversification. One is effectively a private equity acquisition company, and another is basically a managed hedge fund, effectively, of large public
Yeah.
American stocks. So yeah, very interesting either way.
Okay, yeah, good stuff. And yeah, one of the original baby
Yep.
Berkshires. Okay, I've got a few different directions to go with this one. I'm going to start it off very specifically for the Irish audience.
Lovely.
So there's an investment trust, which is treated very differently to an ETF under Irish tax laws. It's treated as an individual stock, called JPMorgan American Investment Trust. Its ticker symbol is JAM on the London Exchange. Um, and it's basically tracked the S&P 500 pretty closely over the past few years. It's actually outperforming it over the past 5 years. And for Irish investors, it's treated the same way as a regular stock for tax purposes, which is very important. No deemed disposal, no 41% exit tax, and you can still own a diversified portfolio of about 280 large and mega cap US holdings. Obviously, the caveat for this, and if you listened to our episode last week on ETFs, is you're just going to pay too much on management fees. It's about 0.35%, I think, management fees on this JAM stock, instead of 0.03% for, say, a Vanguard S&P 500 ETF. But that's the hand we're dealt with at the minute. It's not, I hopefully, now we're saying this, hopefully we speak it into existence. Deemed disposal might be a thing of the past in the near future. This could be a stopgap in between that. If you're just sitting around, you want to invest, you don't really want to think about it, yes, you're going to pay high management fees for a while, but from when the deemed disposal tax has gotten rid of, fingers crossed, you can then start investing into the S&P 500 instead. So if you just look across at the holdings, it's like the top stocks are Microsoft, Amazon, Meta, Apple, Nvidia, very similar to the S&P 500. It is trying to outperform it. So there will be some differences, but nothing huge. It's not completely straightforward. You might have to be approved by your broker before you're able to purchase shares, as I believe the trust might use leverage when buying shares, making it a leveraged process, but I making it a leveraged product. But I think just a quick message to customer support explaining what you want to do should clear things up. And then just the last caveat is it has outperformed the S&P in the last 5 years, but it's underperformed in the past year and year to date. So it essentially has a higher beta than the S&P 500, meaning it amplifies the results in either direction. So if the S&P 500 is doing well, JAM will do slightly better. If it's doing poorly, it'll do slightly worse, if that makes sense. So it kind of is a slight amplification on the results in general. This goes across like that. It's a trading term essentially. I won't sit here and explain it too much because I fully don't understand it too much to give a detailed explanation. But essentially, if results are good, great. But if things are going poorly, like right now, losses are worse. So that's something to take into account too before buying. Now that is not really an individual stock; that's an investment trust. The two individual stocks I'd recommend as a way of indexing without indexing are Mitsubishi Corp and Investor AB. I've talked a lot about Investor AB before. Swedish holding company holds a portfolio of public companies, private equity companies, all rolled into one. Huge international and sector diversification, great track record. Board of investors are essentially, sorry, the board of directors are essentially investors. There's a bit of a Freudian slip, but it's intentional in the sense of they are just buying up a portfolio and building it for you, and they've outperformed the market consistently over the last 20, 10, 5 years. Amazing business to buy, and yeah, you just similar to an index. Dollar cost average to that and forget about it. The one I want to talk about today a bit more in detail is Mitsubishi Corp. So this is Japan's largest trading company. It's got 8 different business divisions: environmental energy, materials, food, mobility, minerals, urban development, power solutions, and smart life solutions, which is kind of just covered the board. You pretty much everything you can think of, Mitsubishi has it. And I know a lot of people will associate Mitsubishi with the cars, which is just one small aspect of it. They've got so many fingers in so many pies, from like old world business side of things. You know, it's got the leading one of the leading copper portfolios in the world. It's also a serious player in natural gas and coal markets. And yet then its more modern business divisions include autonomous driving technologies, and then environmentally friendly synthetic e-fuels, nanotechnology, data centers. So essentially across the board, Mitsubishi has something involved in everything, is one way of saying it. And then what we've seen is a huge interest in Japanese stocks recently from top US investors because they've become a lot more shareholder friendly in recent years. This is like an overhaul in kind of how public companies are run in Japan. We're seeing a rise in dividends, buybacks, and just overall focus on shareholder value. This kind of reform in governments has attracted, and very appropriate for the episode, how we kicked it off, Warren Buffett. He now owns about 10% of Mitsubishi. He owns 10% more or less of the top 5 trading companies in Japan, Mitsubishi being one of them. And he's very committed, or at least he was in his most recent shareholder letter, to holding these stocks for the long term. He's got a great deal there with them. I don't know Greg Abel's opinions on them, but he actually went and said that Mitsubishi was a company that is run in a manner somewhat similar to Berkshire itself. Now, obviously, Mitsubishi doesn't have one of the world's greatest investors at the helm, but it is a good way of looking at the stock. It's that holding company that spans almost every industry and is run as an investment rather than like an operational business, if that makes sense. So owning it would look like an index as well. So those are 3 businesses. One, very appropriate to Irish investors. If you are an American investor, I would not be interested in JAM at all. Just forget about that and invest in your broad market ETF. But if specifically for an Irish investor, that one could solve your problems for now. And then Investor AB and Mitsubishi Corp are 2 great businesses that you can really just dollar cost average into for years to come, and hopefully they will recreate the performance that they've done over the last 5-10 years. And yeah, that's it.
Is the Swedish one the one that does the dental drills?
Dental drills is like specifically, oh no, that's is that Lifco?
Oh yeah, that's Lifco.
Yeah, Lifco is the like 3 big industries. It's like dental drills, demolition companies, and and pneumatic pumps or something crazy like
Yeah,
that.
Emmett pitched that 3 weeks ago. I was pitching Berkshire Hathaway, and that was his equivalent to Berkshire Hathaway, and I was like, "Oh, okay, dental drills and demolition."
You know, geez, Lifco's got better performance than Berkshire Hathaway over the last 10 years.
Yeah,
Anyways, incredible business as
yeah.
well. But yeah, these are 3 very boring businesses, but instant diversification and run more like investment firms than businesses, which is very important because essentially you have some of the top paid investment managers in the world managing your money for you,
Yeah.
and you don't have to pay any management fees because it's an individual stock instead.
Yep.
So that's kind of thought process you can get into about investing passively through individual stocks. And I think this was the purpose of that episode. So yeah, I think you'd be looking pretty good there with those 3 or 4 businesses and kind of set and forget.
Yeah, I would agree. It's particularly with the deemed disposal thing. We keep bringing it up, but we know that we have a massive Irish audience, and that seems to be, we get so much interaction with that kind of content online and via social media and stuff like that. And so, yep, definitely, if you have been looking to start investing and you don't want to wait around to see if deemed disposal gets thrown out in the next year, check out any of these names, and off you go.
Yeah, that'd be a great place to start. And then hopefully we'll be talking this time next year and just set and forget broad market ETF, and we'll see you in 40 years.
Gosh, that will be the day. We will be retiring and be like, okay.
Okay. Anne-Marie, thank you very much for coming on the show. Now we're finishing up with a bit of a one-man act from Emmett. Do you know what? I think this is from the brain of Emmett, and I think Emmett's the best person to introduce this because it's a little bit out there. But yeah, enjoy this little 15 to 20 minute soliloquy from Emmett's behalf to close out the show.
Hey everyone, how you doing? I fear it will be difficult for me to get on a microphone at the same time as Mike this week and next week due to personal reasons, so I thought I'd pre-record a story from 33 years ago that, in a funny way, is an anecdote that encapsulates my approach to investing. It was early 1992 and I was getting ready to sit my leaving certificate examination, which, as most of our listeners will know, is the main state exam here in Ireland that everyone takes at the end of their school life at around the age of 18. The results of that exam determine what you can do in university because places in each college course are limited, so those with the highest points receive the offers. From that day to this, the first Leaving Cert exam is on the subject of English, which involves 6 hours of exam time across 2 sittings on different days. The first paper, at that time anyway, involved writing an essay on a Shakespearean play that you were supposed to have spent 2 years studying, and the second paper related to a whole stack of poems, mostly from Irish poets. As it happens, I did the exam at the age of 17, and my brain at that time was absolutely not wired to understand and absorb a Shakespearean sonnet, let alone Hamlet, which had or has about 30,000 words and is the longest play that Shakespeare ever wrote, which is why full productions usually run over 4 hours when performed without cuts. Now imagine telling a 15 or 16-year-old that they need to comprehensively understand and recall large segments of that play by the time they're 17. Well, I knew I was in trouble, certainly for the Hamlet part of it. The poems were, for me, easy enough. I liked them, and I had, for the most part, learned them by heart. So on that second paper, no matter what the question, I could write down the poem at the top of the answer, which demonstrated I knew it, and I could not only quote it, but I could recite it, and then I could riff on a bit about the meaning and the intent in the hope that I'd accidentally hit on the answer jackpot. But this time, 30 years ago, a matter of days before the Leaving Cert kick-off, I could barely explain the gist of Hamlet, which meant I was in hot water no matter how the questions went. So I sat down before the exam and read through every previous examination on Hamlet, which rotated through a 4-year cycle. So the previous time it had been examined before 1992 was 1988, then 1984, then 1980, and so on. Or in other words, there was not a lot of data to go on. There was a handful of previous questions. However, when I wrote out all the previous questions on a page, I observed that there was never a single question relating to Horatio, who was Hamlet's closest and most trusted friend. And without Horatio, the play loses its emotional core and its sense of justice and all that kind of stuff. He was kind of a pillar to the story. But what I particularly liked at the time, after leafing through the book, through the play, was that Horatio didn't say all that much. He opens the play in the ghost scene and he had a few cracking quotes, but I liked that I could probably memorize everything he said, and to be honest, almost nothing else. So I decided to go all in on Horatio. If question 1 on paper 1 of English on the first day of the Leaving Cert on Wednesday, 10th of June 1992 is about him, I was home and dry for a good grade. If not, I was probably going to land a C1 or a B3 or something like that, which were the grades at the time. Now, only today, 1/3 of a century later, and thanks to the miracle of AI, I have a bar chart here in front of me of the spoken lines by characters in Hamlet, with the play's namesake character commanding the lion's share with about 1,500 lines, followed by Claudius in second place with far less, at 600 lines, followed by Polonius, then only in fourth place is Horatio with a paltry 300 lines. Either way, I didn't know that at the time, and actually I thought it was way less than 300 lines. I had it down as just a handful. So I set to work and I started to highlight everything that Horatio said. And then I spent a solid 2 days, 3 days memorizing every single word. By the way, if like me, you have only a cursory knowledge of the play, Horatio was the guy that said the famous lines, "'Twere good she were spoken with, my lord, for she may strew dangerous conjectures and ill-breeding minds." So there you go. You probably already know that Horatio quote. If not, there you have it. So on that baking hot summer's day, when the Leaving Cert rolled around and I walked into the exam hall to start my Leaving Cert, I was nervous. One of the things that has always stressed me, or at least used to stress me at the time about state exams, was the phenomenon of the person to your left and right who always started to write at breakneck speed the minute the exam paper went down. It's as if the words didn't even bypass their brain. They went in their eyes and out their hands. I'll never understand it. Whereas I usually started exams by looking around the room and just clocking the faces of those around me. I'd look over my shoulder, left and right. I wouldn't even open the paper. I'd eventually do so, of course. But at that time, I remember on day 1 of the Leaving Cert, I looked around the room because I kind of knew I was goosed. I only knew one character. So after a minute or two of sitting there, I opened the paper and question 1 had just 2 words: discuss Horatio. So I remember the hairs going up on the back of my neck. I grabbed my pen, dropped my body, and started to write at a speed comparable to the madmen to my left and right. And at the end, I not only put down almost everything that Horatio had said, but also the impact of those words on Hamlet, the play, and Hamlet, the man. And I'm not much of a speed writer from that day to this, and I do recall my hand was sore at the end of the exam, but I was a happy man because my calculated bet paid off. Paper 2, probably the next day, I don't recall, was a walk in the park, and several months later, at results time, I had landed an A in English, which was notoriously difficult to achieve. But had that paper said discuss Ophelia, who said next to nothing, to be honest, my outcome would have been entirely different. I was lucky. I was just lucky, which by one definition is when preparation meets opportunity. So what has this got to do with growth investing? Or more to my point, what has it to do with my investing style? And the answer is everything. It has everything. It's in my DNA. That discuss Horatio approach is something that has always existed in me. And my approach to investing, like that day in the exam hall, is not a perfect game with perfect information. It's a game where preparation and pattern recognition and conviction with a fair dash of bravery makes all the difference. So let me kind of elaborate. Whatever possessed me at that time when I went all in on Horatio was there when I saw Dell's 1,600-fold growth in the decade that was the 1990s, and me saying to myself, I want one or two of those in my life. I want a few Dells in my portfolio. Now, when you invest for growth, you're studying the past, you're looking at how great companies are built, you look at how innovation takes hold, you look at how markets evolve, and more to the point, how markets are created, and you're trying to place a few intelligent, high conviction investments in the future. Now, unless you're buying an index, you just can't spread yourself across everything. You have to sometimes pick a Horatio and back it, knowing full well that Gertrude or Polonius might turn out to be the ones you should have backed. However, there's a truth that doesn't get said enough. Success in growth investing comes not from constant small wins, but from a few deeply prepared, deeply committed decisions that change everything. The great investors of the world, people like David Gardner of the Motley Fool, or Peter Lynch, or Philip Fisher, and more recently some of the best fund managers today, are not remembered because they had hundreds of tiny, clever trades. They are remembered because they seized a handful of life-changing opportunities and had the courage to act when these opportunities arose. It's always easier to wait. It's easier to tell yourself you'll make the decision when things are more obvious or more comfortable and more certain. But the opportunities that change your life never come gift wrapped. Not to be confused now with solid, steady investments like Amazon today. Like, such an investment will not change your life. Buying Amazon shares today won't change your life. It might grow your wealth. It might preserve your wealth. It's highly unlikely to change your life. However, buying Amazon shares 20 years ago absolutely, certainly would have changed your life had you bought and held through to today. And baby Amazons, those tiny little companies that are like Amazon 20 years ago, are messy and they're controversial and they're uncertain. I mean, as I said in a previous podcast, like I lay on a beach when I read about Amazon and turned to my now wife and said, can you believe David Gardner is recommending buying shares in a $6 billion online bookshop? I thought it was absolutely deranged, but it wasn't deranged. When we buy such companies, a handful reward those who are prepared enough and recognize such companies and are brave enough to act on it and buy them. And there'll be a ton of pretenders to the throne. Like, a perfect example, if you ask me, is investing in CRISPR, the technology today. I think it's going to change the world. It's a technology that's surrounded by debate. It's completely wrapped in regulation, and it's very, very complex. Scientific complexity is off the charts. But those who look past the noise and see its long-term potential, whether it's in curing diseases or transforming agriculture or even reshaping industries, are probably positioning themselves ahead of one of the most revolutionary shifts of our lifetime. There are a whole pile of pure play investments in the CRISPR space. So the question becomes, which one is the Horatio? And that's why I so strongly believe in growth investing and high conviction growth investing. We don't need to pick 100 mega winners. It would be nice, of course, but it would also be impossible. We need to be ready when the right ones appear. We need to put in the work when no one is watching, look for the right idea, the right company, the right founder, and we invest, we forget about it, and we move on and try and find another one. So that summer day, 33 years ago, I was lucky that Horatio showed up on that paper. Preparation did meet opportunity, and investing is no different. You form your convictions, you put a small portion of your hard-earned savings into that company, and you stay patient. Like, remember, the average time it takes for a 100 bagger, that's an investment that multiplies 100-fold, is around 20 to 25 years, like a quarter of a century, a large portion of your life. And research from Chris Mayer's 100 Baggers book, you might remember I interviewed Chris here on Stock Club, and other studies by Thomas Phelps, for example, showed that most extraordinary returns require multiple decades of patience. And a few companies like Amazon or Tesla or Nvidia achieved 100x fold or 100-fold gains in 10 to 15 years, but these are rare exceptions. More commonly, businesses like Monster Beverages or Home Depot took 25 to 30 years to deliver such returns. And achieving a 100 bagger demands not just finding a great business early, but also having the conviction and resilience to buy them and hold them. So to conclude, I believe that everyone, after all, deserves to recall their investing equivalent of discuss Horatio. Okay, talk to you soon, folks.